Can anybody hear me?
I hear you.
Yeah, Eileen, I can. I'm Telesco. I can
Oh,
hear you.
okay, good.
There you go. It's being recorded.
Excellent. I'd like to call the meeting of the Lower Pension Board for July, for the June 11th, 2025. Can you have a roll call, please?
Jim Hendrickson, here.
Charles Pirro.
Jared Schmidt.
Dave Framer.
Chitsme Lamb.
Fred Murdoch from Callan. Kevin Schmidt from Callan.
Acceptance of the meeting, the minutes from the last meeting.
Questions about the minutes. Okay, first, you're not listed, so say your name on the record that telling you we're not listed.
I was not listed. My name is Bob Raleigh.
And I remember he was here.
Yeah, I know. I was
Very
on-
fine, he was here, but he's not listed.
I know he's here.
Okay, couple of problems I have with the minutes. We said first, we said that I had moved to table the application for Donald Caravan pending additional information, but the minutes don't identify what the additional information is. That bothers me because a year from now, some guy comes forward and says, if you approved Donald Caravan pending that additional information, what information? It really would be good to have that in the official document. So we've got to have a lot more detail in the way. And the same thing is in several of the other motions that have come up. My second problem, a couple of lines down says Mr. Hendrickson moved, but it doesn't mean that anybody seconded.
And my name is spelled wrong.
Okay,
Yeah,
it's gotta be corrected. Next paragraph that said she would email the board members with the current collective bargaining agreements. I didn't get that. Did anybody else get it?
No.
Do you know if they have signed it?
Yeah, I don't know if it's actually been signed yet, but they passed the concepts and some of the language has gone through the common council and been adopted, so. They may be putting some finishing touches on the actual language. But we can definitely give you the kind of all the concepts that were included in there. We can forward that to you.
One of the issues in here was whether it's covered by the board rules or by the collective bargaining agreement. It would be helpful to have the agreement. I think that was one of the issues. The other question I had was committees. And I still think we need to get a legal opinion on whether OPEB and the others are committees of this board or a separate board. But we have a separate board for food services.
Right.
And it's a problem because if there's a separate board for OPEB, then there has to be an official notice given of an OPEB meeting. We can't include it in the notice of our meeting legally.
So we did talk to our corporation counsel. The resolution that they came up with for these meetings was to separate it out within the agenda, so they would be part of this, they would be part of one umbrella meeting. But each of the committees, whether it was the defined benefit plan, defined contribution plan, or the OPEB, that they would be included as separate sections of this meeting.
That's not the answer. Well, the meeting doesn't solve the problem. Are they under this board and this board, or are they a separate program with a separate board? Can be the same people. In fact, food services, they're different people. I think maybe three of us are on the food services board, not everybody else. And automatically are all of us members of the OPEB board or just three or four of us?
All of you. You're all members
Of the
of the
OPEB
OPEB
board,
board.
so they're a separate board. That's what you're saying.
It's a
We-
separate,
We need a definitive answer.
it's a committee, and we have a definitive answer.
Yeah.
Whether you like it or not, I don't know, but they're.
Well, like it or not, we need to know.
Right,
And I've never seen an official opinion.
One of the things, we discussed, and I discussed with Ryan, his main was that the committee, the city council voted to start, OPEB. Okay, so it's the city council, so that's, and they said that's a committee. Not a committee, but that's a board. And has the city council said that the pension board is now gonna have, no longer gonna have a separate OPEB board? That's, I think, the question.
Yeah, that's, well, we've been operating for years as though it's a separate board.
Yes.
And we issued a legal notice of a separate meeting, we scheduled this meeting at 6
Right, and we-
o'clock. We scheduled OPED at 6:30, anything else at 7 o'clock, and that's official notice. Without that, any action we take may not be valid.
Well, you have
That's what I'm
to,
afraid of, that's something we do.
Right, so what I'm saying is that our attorney determined that we could do everything as one meeting, there would just be notice for one meeting. And within there would be a separate section dedicated to OPEB or whichever one of the other entities, if we want to call them entities, the contribution would be, they'd be separately addressed within the agenda, because that's what you're talking about. Or we have, I think in practical terms, you want to know, do we need to schedule a separate meeting for each one of them?
Yes.
Or do we not?
Which is what
And
we've been doing for years.
And what he says is no, that we don't. We can do it as one meeting, one agenda, and have separate sections of the agenda for each of
These
them.
words matter. Is that a
I
separate
understand.
meeting
I
or a separate agenda, but key word is there a separate board? Or is this the same board for each of them?
I think I'm answering your question because you want to know how do we practically treat it, whether it's a separate board or separate committee or
That makes a big,
however
that
however
makes
you
a
want
big
it,
difference.
however you
Whether
want,
it's a
however you
separate
want to
board or a
define it.
committee makes a big difference. If a separate board, there has to be a notice of a meeting of that board. A committee can be part of the notice of the meeting of this board. So that's the big difference.
can I ask the question, why the change? Whose idea was the change?
It came up as a result of your conversation with Tom, and I don't know.
No,
But what?
excuse me, my conversation with Tom only started because someone decided to make changes. It is not, I did not
Then
initiate this.
I don't know. I don't know. Well, I don't know where it started then.
In fact, I called Tom when I was actually in Massachusetts, when my daughter was being treated for cancer, saying, why is this going on?
Yeah.
And the other thing is, I think we have separate, we have to decide whether or not, like, we have, maybe within OPEB and within our board, the pension board, we do have some different specifications, right? So those specifications, I mean, are they now void? Are they, how,
Or if we make an allocation of funds other than what we've had before, it's valid.
right?
I'm not questioning you, and please understand,
Right.
but Corporation Council telling you verbally and then you telling us verbally, that's not legally.
Yeah.
I mean, as a lawyer, I would not accept any of that.
Yeah, and we've had emails going back and forth, and the ideas have been in writing, there's not an official single opinion.
Well,
about
we
it, but-
need to see something that tells us how to operate. We need something that tells us what legal notices to give. I mean, somebody's gonna come along and say, well, wait a minute, you didn't notice the meeting and you changed the money and you cost me some of the money I was supposed to get. And they're gonna sue the city, they're gonna sue us,
Do
Again,
you,
I'm thinking like a lawyer.
do you believe that if the OPEB is a separate board, a completely separate board, even though it's made up of the same members, that you still have to have a separate meeting?
Yes.
For OPEB?
Yes.
You can't,
Yes,
you can't include that within a pension
Which would be- we've
board
been doing that.
meeting.
yes.
Right.
With the understanding that there's no OPEB portion of it.
Yeah, we've been adjourning the pension board and
Have the other.
opening up the
How we
OPEB board
operate every
meetings
year.
back to back.
So.
Yeah, so here's
Take a worst case scenario.
here's
He
the
says he
problem.
doesn't want to sit on the OPEB board.
Right.
He's a member of this board, but he doesn't want to sit on the OPEB board. It makes it sound like it's a separate board.
Yeah,
So
no,
here's the-
Can I speak for a minute? Can I speak for a minute? The other thing too is this.
Yeah.
As this evolves, I mean, years from now, the investment for the pension plan, because it's gonna be predominantly for police and fire, and they're gonna be different ways to invest because they're maybe for perpetuity. And OPEB could be increasing or decreasing and the defined contribution is gonna be changing over time. It's gonna, in 10 years, it could be more money in defined contribution than there is in the portion for people who work for the city. Would you, I hope you all agree to that. What I would like maybe possibly is for this board, for somebody on this board to make a motion that we ask the city to continue as we previously did, where we had separate boards. Does that make sense to anybody, or does anybody disagree with that idea?
I think it's fine, but the question is, isn't some of this reflected in the city charter? I thought we went through this a few
I
years
believe
ago.
it's a combination of some of it's in the charter and some of it's done by ordinance. I think the OPEB entity was set up by ordinance, not by charter.
So whatever we do
Wait, it
here,
was- But, excuse me, it was set up, it was voted on by the city council.
Right.
Right.
That's
so
an
that's-
ordinance.
Right, that's the ordinance there, so. And it has a,
and the same thing with the DC plan.
right,
I mean, the city council could have passed an ordinance which said that it's in a committee of this board. Or they could have passed an ordinance that said it's a separate program with a separate board.
and you and I were here when they started OPEB.
Yeah.
And all they did is they came in one day and said, we voted for OPEB, we're gonna start OPEB, and you guys are the committee.
You guys are the board.
Not the
No, they
board.
said they used the
You-
word
You're the
board.
board,
You
I
guys
know,
are the
I stand
board.
corrected,
Yeah.
they use the word board,
And that's,
There's
that's
a
the
new
problem. You gotta
board.
be very careful
right,
with.
and that's why I corrected myself,
Yeah.
okay?
So before you do that, can I suggest that I go back to Corporation Council and have them write an official opinion on this so that you know? Because here's what the problem is. It's practically, it's gonna be, it's gonna make it more difficult for you guys to run meetings, because if you set up a meeting for 6:30, let's say you do OPEB at 6 and then pension board at 6:30. You can't, first of all, you can't start that meeting early, so if you end OPEB at 6:05, you need to wait around for 25 minutes. You're gonna have to start at 6:30, and then if OPEB goes over, you've gotta then convene the pension meeting. You gotta break the OPEB meeting, convene the pension meeting, recess the pension meeting, go finish your pension meeting, go, you know what I mean?
We've been doing
It's gonna make things.
We've been doing
it's gonna make things
this
very-
for years.
I know, but you.
And
yeah,
we've
that's
never,
one right.
ever had that problem.
Right, we've done it for at least 15
Yeah.
years.
Yeah.
And all we do is we have the general meeting to start.
Yeah.
And then we, after that meeting ends, then we go to either the OPEB meeting like we do tonight.
Yeah.
And then we just say, okay, one meeting's adjourned, call the second meeting to order.
Yeah, we haven't
Set
had
minutes.
start times for the second meeting.
Yeah.
It's just been
Yeah.
a start time for the series of meetings that way.
Right.
All right, so then you don't really have a separate meeting then. If you don't have,
Oh,
if
yeah,
there's not a
no,
time. for it,
we
you don't
adjourned the
really have a
pension,
separate
no,
meeting.
we adjourned the pension meeting, voted to adjourn it passed. Then we called to order the OPEB meeting.
Okay,
So time is
And
after.
voted on
pension
the-
but
meeting.
you haven't noticed
You
that
haven't
meeting,
noticed
so
that.
you
Yeah.
don't have a separate,
Yes.
you don't.
I think
not
he's
if
saying you
there's not a
haven't,
time to it.
he's
If
saying
there's
you
not a
haven't noticed it
specific
if
time
we
to it,
haven't
then
put a
you-
specific start time on it.
I think there was
Yeah,
a specific,
we always said you-
but it was,
we always said
it was like
6:30.
Right.
15 or 30
No,
minutes
if
after.
the regular
the
meeting
pensions
went
started.
over, then
So it was
OPEB
never-
started later.
never had to wait
But there
for-
was always a notice, there was always a time. And
Okay,
we never had a problem where we had to wait around for the next meeting. That was never a problem. There were times when the meeting went longer and then we had to wait for the second one.
okay. So let me go back to them and I'll get a final, an official opinion from them, and then you guys can decide what you want.
Excellent.
What you
Right.
and what the rules of the road are, depending on that opinion.
Yeah,
I mean,
Mr. Chairman, I'd be inclined to
You know,
not
we
have
have to
open meeting
adjourn,
tonight, so we actually get this started.
recess, start,
We don't have a notice. you know.
Recess,
If the
start.
decision is it's a
Right,
separate
right.
board, separate meeting, we don't have an official notice of it.
Would I ask before? Does anybody?
I
think
don't
that we
wanna
should-
do a motion, I wanna wait until,
Yes.
we get the
Yeah.
opinion out of the city.
Like to get.
I just think, what I was hoping was to show them the
We just want an
consensus of
answer
this
so
was
we
to
know
keep
that
doing
we're
it.
doing it legal.
Well, let's, how we've been doing it may not, we may learn something.
Yeah. Okay,
And the other thing is the change for Donald Caraval. It was because we wanted to know whether to add this to the minutes, right? We wanted to know whether or not there was any, it was, if I remember correctly, he designated his son, right? And all we wanted to know was there a spouse involved? And if there was a spouse involved,
Yes.
if it was an ex-spouse involved, was there any agreements? That's what we
I'm
wanted.
older, I have an excuse, but I did not remember that.
Well,
And cause it wasn't, and the fact that it wasn't in here is
Right.
how, for me personally, maybe not anybody else,
but you
it's gotta
could,
be in there.
okay, so you should propose the change.
Okay, I ask that we amend the minutes to include in on page 2, we tabled we tabled the application for Donald Caravan pending additional information concerning whether there was a spousal claim or possible spousal claim. And we're still waiting for that information apparently because it's not on the agenda tonight.
Correct.
So I move we amend the minutes to reflect that.
I will second that.
All in favor? Opposed? You're gonna say something. That's why you're not in the minutes. You're soft. Okay, so
Second thing with the motion for approving the other two pensions, do we know who seconded it? Mr. Hendrickson moved.
I think I did.
Okay, good. So add that.
There we go. That was, I try to jot notes down on who's motioning and who's seconding to back up whoever takes the minutes, and that's what I actually had.
So secondly,
Thank you for thinking.
I move we
Seconding
amend the
my
minutes to
second.
add that he seconded
Right.
that motion. To approve the other two pensions.
is there a second? All in favor?
Aye.
Opposed? No, thank you very much. Everybody's with those, is there a motion to accept the minutes as amended?
This is for the May meeting,
Pardon?
for the May meeting.
Yes. well,
It's for the
yes,
meeting.
Just amended.
I will move to accept the minutes for the May meeting with the previously mentioned adjustment.
And Mr. Bass
All in
seconds.
favor? Aye. Thank you very much. So. I don't have executive session for a minute.
Oh, okay.
Is there any public comment? Thank you. There are no pension applications, but the Donald Caravan, we didn't get anything, and I don't know whether anyone is here to discuss. I don't think so.
No.
Everything's there?
Got the December minutes also, right? Oh, that was okay.
Yeah, that was.
Never mind.
No public comment, no pension applications, but we should, but. For the record, we'd like the conclusion of the Donald Caravan at the next meeting. Reports.
Great. We were going to run through the April performance report
for the pension, provide a quick update on the market environment as it's changing day by day. We also have Kevin Matches from our Capital Markets Research Group on the line to discuss the fixed income structure analysis. So we will run through performance. We also included in the binders a recommendation to raise $9 million for TITS May for benefit payments over the summer. So Kevin, do you want to provide a market backdrop?
Yeah, pretty sharp downturn in the markets in April, really coming on the heels of the tariff announcement from the US administration. April 2nd, we had President Trump declare 10% baseline tariff rate on imported goods from all countries and higher reciprocal tariffs on around 60 countries and regions in which the US has significant trade deficits. The news and any other subsequent announcements of retaliation by China really spooked investors, and the S&P 500 posted its worst week as a result since the onset of the COVID pandemic. And we also saw the VIX index, which is the gauge of market volatility, cross 40, which is a pretty pivotal, number, if you will. The markets, however, did get a little bit of a sigh of relief in the subsequent weeks as Trump administration walked back a lot of the timing and intensity of the tariffs. So the S&P 500 ended up finishing the month with 7-day winning streak, and the VIX subsequently ended the month below 25. So a lot of volatility and really kind of reset to where we were a few months ago. The initial tariffs, everybody knows, were a lot harsher than expected. There's still a lot of questions remaining around their implementation and the outcome of any ongoing negotiations. We do expect continued market volatility, especially as it relates to China at this point. So TBD on that front. In terms of the numbers for the market, the equity index finished in the red. The S&P was down a little over 0.5%, which is pretty amazing given that the sharp sell-off at the beginning of the month. Small caps were bigger losers, around 2.5% for the month in terms of the Russell 2000 index. And then outside of the US, they actually outperformed, and a lot of that had to do with the on a relative basis in terms of the weakness in the US dollar, providing a tailwind to those markets. So MSCI EP was up 4.5% for the month, and MSCI EM ended almost 1.5% for the month of April. After what was a tough start to the month, Treasury yields actually did respond favorably to the uncertainty. So the 10-year yield was down 5 basis points to about 4.16. Speculation and rumors around investors losing confidence kind of reinstilled treasuries as a safe haven during the markets boiling. The final weeks of April kind of served as that reminder of again, why U.S. treasuries are seen as like this bastion of safety during kind of these times of distress. And then we saw Jerome Powell kind of reiterate the central bank stance of being in no hurry to lower interest rates as a result. So as a result, the modest steepening in the Treasury yield curve, fixed income returns mixed. In terms of IG spreads, they rose about 12 basis points to 106, and high yield spreads increased 37 basis points. And then lastly, one thing I'll just kind of mention, the area that bore the brunt of the market in terms of volatility was the commodity space. So price of oil declined pretty dramatically, down almost 19% for the month. And then we saw gold continue to have a stellar run, offsetting the weakness in the commodity side with gains of around 5% for April, just to kind of give a full picture of everything that was happening.
Thanks. And maybe on a rosier note, since April, we've seen equity markets continue on an upward trend. In May, S&P 500 was up 6.3%, up 7.9% quarter to date. Non-US equities up about 10.5%. Fixed income returns largely flat, slightly negative for the quarter. So, the good news is that public equities, in particular international, have rebounded pretty significantly since those first 2 weeks of April. I'll pull up the April flash report. I think it's in the first section of the hard copies. The total assets were 522 million at the end of April. Equity in the US largely in line with the target, slight overweight to international equity, underweight to domestic fixed income, and overweights to both absolute return and PIMCO all asset, but well within target ranges. We have performance on the next page. A few things to note for the fiscal year to date performance. Principal has really struggled in 2025. They had a pretty good year last year, but they have really pulled back so far, as you can see, fiscal year to date, trailing their benchmark pretty significantly, largely due to healthcare stocks and this market volatility, especially in the small cap market that we're seeing. They got whipsawed pretty good coming out of last year. Within international equity, Silchester on an absolute basis has done very well, up about 10%, but struggling to keep up with that EFA value index. Most of that is we've seen a big rally in financial stocks, both domestically and abroad. Silchester owns very few financial stocks, as well as defense companies. Again, we've seen a rally as foreign governments have beefed up their own pledges to build up infrastructure within their countries, like Germany, and Silchester, really has typically had an underweight or very little weight in both financials and defense sectors. Similarly, Walter Scott has struggled. This is not just Norwalk's international strategy, it's also their world strategy. The growth at a reasonable price process. Again, they're going to own very few financials, which has really driven the EFA value index. You can see the EFA growth index slightly positive fiscal year to date, while Walter Scott has underperformed. BlackRock Emerging Markets has struggled for the fiscal year. They tend to invest in smaller market cap stocks than the emerging markets index. They're overweight to technology, which has really sold off in 2025. And again, underweight to financials, similar story to your development managers. On a positive note, ABS has done a nice job amongst the volatility, outperforming the HFRI strategic benchmark, and longer term returns continue to be positive. And on the next slide, we have fixed income. Your fixed income managers have outperformed fiscal year to date. TCW, MetWest did have a strong first quarter, as they are more conservatively positioned. Despite their duration positioning, they tend to own a lot less credit, which you'll see in our fixed income structure analysis. And UBS has done a great job, significantly outperforming their benchmark. And then lastly, PIMCO, trailing their TIPS benchmark. We are adding a CPI +5 secondary benchmark so that we can evaluate that fund more closely over longer periods. Most of that underperformance is really some of their risk exposures within US small cap equity. So overall, fiscal year to date through April, up 4%, trailing its benchmark, largely driven by the active equity managers. Any questions on performance?
So Silchester's outperformed Walter Scott and BlackRock, correct?
Yes, they are very different managers. I think the reason for our suggesting that we take money from Silchester is that they're the largest position within the pension plan. And you're overweight international equity versus the target. And then PIMCO, you're also overweight by about 1% versus the target.
Well, PIMCO has no more money than really, basically. Walter Scott is 35 million. And PIMCO's 36. Right, and PIMCO. Today the oil is up over $3, it's taking out its April highs. The metals complex has been very strong. Platinum's up almost 40% in 2 months. There are some who feel that, there's going to be inflation, so does it make sense to take? PIMCO is probably our closest thing to an inflation hedge.
I don't disagree with you. Our recommendation is strictly coming from where are you overweight versus your target and your strategic policy.
How do you see overweight international?
If you look at page 1 of the flash report, 23.8% versus 23% target, slightly overweight. But international, again, since April has done very well.
23.8 versus 23, so still, okay, so. Looking at the right hand side there, that was March, yeah,
That's generally how we approach any,
yeah.
right, is to always work back to your strategic long-term allocation as opposed to taking, regardless of maybe what the markets might be telling you or not. Just to take
And the
that,
reason we wouldn't,
But but if I'm not mistaken, PIMCO, I mean, you have 7%, but isn't it like really 5 to 10 or something like that? Because we had a very broad range for a lot of these.
it's not the range that we're working back to, it's the actual,
Well, what I want to do is if we stay within the range.
correct. Yeah. Sorry,
Okay,
that's not what I
My
meant.
question is,
the range is it's broad.
right, it's a
It's
broad
4 to
range,
10%.
so we're still
You are.
in the range,
Absolutely.
okay. So we're not taking it because it's out of the range, you
Right.
guys are making a decision to take the money out of it, but it's still within the range.
Absolutely. And we're just making, this is our recommendation.
Recommendation, not a decision.
Yeah.
With-
I just want to clarify all that when we
Yep.
go.
And it hasn't, and just, we're not making a call on what we think inflation is gonna do, what we think markets are gonna do. We believe in adhering to the investment policy and the targets, and we're overweight in these 2 asset classes, and we think that those could be areas to raise money from. But if the board feels differently, we can certainly understand that.
So where's your 9 coming from again?
It is 5 million from PIMCO, which would bring it in line with its target, and 4 million from Silchester.
It's not, the target is 4 to 10, so whether we take no money out or whether we take 5 million out, we are within target.
We have to clarify, the target is a singular number. There's a range around each target. The IPS defines it.
Excuse me, I was here when we did this, and we said we were gonna have a range. We did not have a specific target. And there was even times when I spoke to Britt and asked that it be shown
Range.
on our statement, the range, not a specific number.
We have both, though, and the investment policy has an actual singular target as well as the supporting target range.
And the numbers here are from the single range, the single target from the IPS.
I wanna make sure we understand the clarification between the 2. Every single asset class has a singular number that's a target. Surrounding each is a range of flexibility so that you're not confined to your comment. If you want to over or underweight, if the board wants to over or underweight at any point in time, you have the liberty to, where you're not confined to say we're forced to rebalance. You have that ability then based on your decision to do so, but there is a very singular number attached to each asset class at the end of the day.
And all of the asset classes are well within their target
Right.
ranges. And, this is Callan's recommendation, but we can understand if the board feels different.
What are you thinking, Frank?
I don't think, I mean, honestly, I think Walter Scott's done poorly. Right?
Yeah.
I'd rather take some First of all, I mean. Rich was really smart because he told us to put more money in Silchester and it's done pretty well. Thank you. And, so
I don't know how smart I was.
you said,
I don't know how smart I was. I just like the way they make
better be
decisions.
lucky than smart sometimes. I mean, so I'm not as big on, I don't think, you know, our real asset is a really, relatively speaking, a small portion of our fund. And I think real assets are, you know, although you talk about being balanced, there is sometimes, there's a sense that this board has even shown, which was quite a good decision by this board to be underweight fixed income, which over the last 7 years has been terrible. Okay, so I don't see where we reduce real assets by even a greater amount.
I'm glad to agree. I mean, going back a lot further, it's always been the policy. Don't take it away from the manager who's really doing well. That was our problem with Zeviger. I mean, every meeting we came in and he made more money and we had to take money away.
Right,
But that's so very reluctant. you
right.
know, And sometimes we did, because he was doing really well. We had one other manager who did really well, same thing, we never took the money away. Eventually, the guy left and we changed managers, but, you know, you don't take the money away from the people who are the most successful.
I mean, I think that I've always believed that you keep your winners and your losers.
But you're reluctant to take it from Concordant, why not be reluctant to take it from Silchester?
So Frank, I'm generally agreeing with you on your premise on inflation, but let's hear your thoughts on inflation. Do you think we're gonna see price increases as we've got the inflation's now around 2%, but at some point we're gonna feel the crunch from tariffs. What
I
do you
think
think?
even the New York Times the other day wrote an article about the credibility of the CPI, right?
Yeah, I read that, yeah.
Yeah, and, like, let's
With
see,
CPI, that's the problem, there are four of them.
well, right. That's
Consumer
true.
price index, core consumer price index. core
That's true,
consumer
but they're all
price index,
basically-
Something else, yeah.
But,
But there's
I do think that I'd say that I'm suspect that inflation is 2%. And when we get our tax bills, everybody here lives in Norwalk, when you see how much your property taxes go up, then tell me that rolls into your 2%. So I do think that, and I think the Fed will, I do believe that rates will probably come down and that's gonna be good for assets.
Just so it's, on the record, just so Walter Scott is the growth manager in the international space. Silchester is representing the value side. Typically, when we're building out structure studies, we're looking for neutrality from a style standpoint. Obviously, you all can choose to flex as much as you want, one way or the other on that. I just want to make sure that
Right, one of the things is neutrality sometimes too, is within the stock market was, well, there's like large cap and small cap, right? And we're small cap has underperformed, 9 years in a row, so.
I'm just talking
No, So
stylistically.
can I finish kindly?
Sure.
So to say that, there can be a situation where if you were balanced with large cap and small cap, you didn't do that well, so you would have been better off to be more weighted in the large cap. By the same token, we might be better off with more money in Silchester because Silchester's has proven and maybe value in obviously there's been a big rally in overseas markets. Value hasn't been as big a participant. Okay, so why do we sell the one that's doing well and keep the one that's not? That's to me, not the way you become successful.
I just wanted everybody to understand that. You can, again, the board can make their decision. I just wanted to make sure that everybody understood how we're thinking about this from our side.
No, again, yeah.
What I'm afraid is Chisholm's gonna raise her hand and she says, I want 15 million.
No, no, we just want to mention that the city will be contributing also because it's the next fiscal year coming up in July. I believe the pension ADAC contribution is around 22 million. I mean, we technically could use that.
Use that money instead of change anything.
Correct, yes, and then we'll send the remaining to the, the pension fund, and then you would decide where do you want to allocate.
13 million then.
Correct.
Yeah, like a different problem.
Right, so we're gonna get 22 million?
That's the ADAC recommendation, yes,
And that would come July 1st, right?
in July.
Yeah, July.
Mhm.
What
The
about,
ADAC recommend, is it budgeted and is it approved by the common council, 22 million?
Yeah.
Okay,
Yeah.
all right, so I just wanted to.
And you're okay,
Get a recommendation versus.
Yeah.
The definitive.
you have enough money to get to that point, till they get that money from the city?
Yeah,
Okay. But we don't need to
Don't need to sell anything.
take that out now.
so then that means we don't have to take any money out?
No,
We'll
no.
be able to get money.
yeah, we'll get it from the city's contribution.
Then we allocate the 13, how we want to allocate 13.
We have
Yes.
a July meeting or not?
Well,
There's no July, there's no July or August meeting.
we would wait, we'd want to see, just gosh forbid the market shift in the meantime, we wouldn't want to do it now.
What about,
Okay.
what about if we put the balance in the cash? Cash hasn't done 4% now, is it?
For one.
Is that good?
Yeah, that's fine, we're only 1.5 now.
What's that, 4.5?
1.5.
1.5.
Oh, I mean, no, I'm talking about the,
Percentage, the
The
return,
percentage.
not the
The
return,
percentage.
not the percentage of the assets.
Our allocation
Return
is
is
one, our allocation is
4.5%.
1.5.
okay, so.
We wanna, I would like to move that we postpone the decision to do a rebalance at this time. And we need the cash, the cash needs until the next meeting in September by using the city July 2026 fiscal year, 26 fiscal year. And that any unused, and that money goes into cash. And any funds that are needed to pay pensions comes out of cash. With the decision, with the next decision point being in the September meeting.
$9 million.
Second.
Do we put in there also up to $9 million for that? Just like we're budgeting at 9 million? or
No, we don't.
We don't need to clarify that because.
It's a good point, but I don't think we need.
Yeah. If it's a little more, it's a little less. It's okay.
Is there any discussion on that very long proposal? And I would hope there isn't, and is there a second?
I got a second.
Okay, all in favor?
And Charlie, I expect you to proofread that in the minutes. I expect you to proofread that in the minutes. My motion.
Okay.
Okay, all in favor?
Aye.
Opposed? No, excellent, thank you very much.
Thank you, Tiffany. Yeah, that really, that solved the problem. Yeah, much easier.
Okay, so then, if there's nothing else about the review, we're gonna go with fixed income structure.
Great. So we're joined by Kevin Matches from our Capital Markets Research Group, who helped put this analysis together. I think given the discussions that we've had with the board over the last, really 2 years. And, some of the, I think, frustrations with how fixed income performed. And in particular, TCW, and the discussion on short duration and bringing the duration down in the overall portfolio, we wanted to put some analysis together to really show the board, what it means if you were to replace TCW with another core plus manager, or if you were to add a short duration sleeve to the fixed income portfolio. With that, Kevin, I'll turn it over to you to walk us through the presentation.
All right, thanks everyone. And yeah, I'll defer to you, Britt, if you want me to share the presentation materials on screen or just call out the page number here, but I'll turn to page 2.
Perfect. Yeah, we all have the materials in front of us.
Okay, great. Yeah, so on page 2, this is just our introduction, reviewing fixed income structure for both pension and OPEB. Your current approach here is core fixed income and core plus managed by PGIM or Prudential, as well as TCW respectively. And so what we're examining here is replacing TCW potentially and thinking about whether to do that with a simple replacement of a kind of comparable core plus strategy or looking at a short duration strategy that would reduce the overall duration of the fixed income structure and reduce that sensitivity of your fixed income structure to interest rates. So turning to page 3 here, this is just happens to be a snapshot from December 31 of your asset allocation. So the top is pension, the bottom is OPEB. The left is the actual asset allocation, and the right is these targets that you've been talking about. And so I think the key differences to point out here, right, is that you have this 4% target to cash. And so it is, I think, appropriate to think about if you make a change to fixed income, that structure, does that impact how you think about this cash target allocation here? As well, there are some less liquid exposures in there, whether that's private equity or equity long short or absolute return, that are present in the pension that are not in the OPEB, right? The OPEB is purely liquid public markets here. And so we'll get into a little bit more on liquidity in a second. But to kind of set the stage on page 5 here, page 5 I think really illustrates how we think about fixed income, right? What is the role of fixed income? We isolate just these periods in the green here where the stock market, represented by the S&P 500 index, are in these declining periods. You can see some of them are fairly large. And we look at how does fixed income, represented by the Bloomberg Aggregate Index, perform in those periods. And what you see is it's not 100% of the time, but the overwhelming majority of the time, fixed income tends to perform well in those periods. And so it really serves as this low risk anchor. That's what we're hoping to kind of achieve out of a fixed income structure. Okay, so turning to page 6, this is getting a little deeper into that question of liquidity I was just talking about. So you have contributions from the employer and the members there in the blue and the orange. That is primarily where you're seeing money coming in. And this is historical, so this doesn't reflect the kind of 22 million that you were just hearing about. But we are seeing some increase over time there, so that trend is continuing. And then you in the green have the benefit payments that need to be paid out of your assets to the members, and also is increasing in size. And so the net effect is this purple line here, the net cash flows. In 2024 worked out to a negative 19 million, or just under 4% of your current portfolio. And so what we're going to be examining in these materials is looking at that fixed income structure. If you were to put say 20%, a portion into a shorter duration strategy, that would be sufficient to cover about 1 year of net cash flows. So it would provide you, quite a bit of liquidity coverage if you were to go down that path. But as I mentioned, you also have this cash target at 4%. And so, that would amount to, about 7.8% of assets in cash and short duration if you were to have both. And so, that would be quite a lot. And you might want to think about, reducing a target allocation to cash if you were to incorporate short duration in the pension. Turning to page 7, this is a similar look, but now focusing on the OPEB plan. And so the liquidity picture is quite different. So the contributions have come down as this plan has gone into surplus. And so you still have to make those benefit payments. They still have to come out of the plan. And so that means your net cash flows turn from positive over time to negative in the last couple of years. And that happens to work out to about 4% of your current portfolio. So it's a big, liquidity need, but the flip side is this portfolio, OPEB, is more liquid than the pension plan. Okay, so the next point I want to bring up here is on page 9. This is some background research we've done on active core fixed income. And the headline number I want to turn your attention to here is this average annualized 3-year excess return for a median manager of 47 basis points, close to 0.5%. And so when you think about that compared to, say your fees of 12 basis points that you pay for Prudential, we think you have a very good chance, high probability of success when it comes to, effectively beating your benchmark net of fees. And then turning to page 10, this is a similar look, but now with Core Plus. So these managers, they do take a higher amount of credit risk in their portfolios. And so the median performance, has been higher. So they tend to outperform the index by 98 basis points, nearly a full percentage point, annualized over time. And so, when you think about the fees there, in the kind of 35 to 37 basis points for yourselves, we think a very high chance for long-term investors when it comes to trying to beat this Bloomberg aggregate benchmark here. Okay, so turning to page 11, we know there has been this concern when it comes to duration or interest rate risk from TCW in particular. So that happens to be the blue line over time. And we can see in the last several years, they have been quite a bit overweight duration or interest rate risk relative to the Bloomberg aggregate index that's shown in black there. And then as well, overweight versus say, your other manager Prudential in green, or this gray area, which is the range of core fixed income managers. So it's a pretty meaningful overweight duration position that they've taken on in anticipation, they think, of falling interest rates, and that has not quite played out. So it's been a headwind for their returns. Turning to page 14. Now we're getting into some potential ways to address this issue. We look at what we call Mix A, incorporating Core Plus strategies, just replacing the TCW Core Plus with a new Core Plus manager. It happens to be equal weight between your existing Prudential Core mandate and this potential new replacement. By contrast, Mix B, call it incorporating short duration treasuries. That's going to assume a 20% allocation to a passively managed short treasury manager. So their objective is just to match the returns of a short treasury index. And then the remaining 80% would go to your current Prudential core fixed income mandate. And so that's on the next page, page 15, is just spelled out in numbers.
So this would, excuse me, would this say that we have no Core Plus manager? If we go with the Mix B?
Correct.
That's right. That's what we looked at for Mix B, is a much more conservative approach. So it's going to have lower interest rate risk. It's going to have lower credit risk. So, much more conservative kind of across the board there.
But I thought we were focusing on the duration aspect to it, not the credit risk aspect to it. our focus was to shorten the duration. And right now, we're having our core plus person is not taking, is generating, trying to generate their excess returns on duration, not credit. Is that correct?
That's right. And so, that's what we thought about a lot with mixed A is if you were to replace TCW, we would expect that to be a manager who is going to have stricter guidelines on duration. Their style is not going to be to make those kind of active views on duration a part of their portfolio. And they're going to have more consistent use of credit. So it's perhaps a little more in line with what we see from most core plus managers in the peer group. TCW frankly has been extremely conservative on credit versus their peers.
Could I?
Thank you.
Okay.
No, I just wanted to clarify that point, make sure I understood.
I like the idea of shorting duration. But rather than having a fund manager, I mean, they do have some short-term ETF funds. And just like we have an ETF fund for, I mean, why pay somebody to try to beat the market and they consistently don't? Why not just put the money in
In mix B, we're suggesting an indexed short duration
just a
treasury.
shorter index where the fees are gonna be just a couple basis points.
Exactly. So on page 15, you can see the hypothetical fee savings
Right,
where the fixed income structure would go from 25 basis points to 10 basis points if you were to implement with just Prudential and a short duration index.
right.
The other part of it too is I think what Kevin was talking about back on slide 10 perhaps is that the median manager for Core Plus is added net of fees, like pretty consistently over time. It's TCW that hasn't. Unfortunately, it's been the manager here because of that duration that's worked against us. So we still think that it's very viable space for a manager, an active manager to add value. Just not TCW, unfortunately.
Well, over the last 5 years, they've both lost money, so adding value, they didn't do.
Well,
I mean, Mark, you and me, I hate bonds.
adding it relative to the benchmark?
No, I'm just saying that.
Well, that's where we gotta
Net
measure.
is that they've lost money.
Well, that's fine,
Right.
but that's not the point. The point here is to reallocate a certain amount of money to fixed income, and then our job is to pick a manager who's going to
We need to
beat
make,
that benchmark.
right,
It isn't whether we're gonna make or lose money in fixed income.
And the earlier analysis showed that the aggregate, if you look at all the managers, they have produced, excess returns that exceed the 15 points on here.
but the problem is that the instrument itself has a lot of risk.
Well, I don't know whether it has a lot. It has less risk than equity.
Yeah.
And so I don't know whether that's a lot or a little.
Yeah,
But
Page 5 tells us.
Slide 5, thank you. Yeah. It's unfortunately, it's like a dual headwind in terms of the manager and also the period of time.
Yeah.
Those 3 quarters rolling 2022, but in most other time periods, the correlation has been negative with equities, and that's what over the long term we would expect. And that's why we have it as a diversifier.
We had a manager that was getting way out of bounds on duration.
Right.
At exactly the wrong time.
Coupled with an asset class that didn't, for that period, didn't provide the diversification that
Right.
historically. we
Spreads-
would expect.
The spreads have all widened. The 30 over the 10 years gone from 18 basis points to 50. Right? I mean, so the duration is what, I think duration is what we don't want.
that's,
Right, I agree with that.
we want less, we want a
We want-
manager that there are 2 ways We want less duration. There are two ways of doing that, if I understand Kevin's presentation correct. One way is to just go with short-term treasuries, take no credit risk. Another way to lower the duration is to go with a manager who takes credit risk, but has a strict operating procedure not to deviate so much from the Bloomberg aggregate benchmark. The duration of the Bloomberg aggregate benchmark.
But what would that duration, I mean, do you have a fund where they don't go out more than, say, 2 years or?
Well, I think most core plus managers that. You know, our research team has high conviction and are plus or minus a half a year to the Bloomberg aggregate index. And the
What is a Bloomberg
aggregate is, the aggregate's
That's
6
on
years.
page 11.
And they'll be diversified across the yield curve, but in totality, the duration of the portfolio will be around 6 years. TCW, which, you know, I think we pointed out on page 11, you know, in the last 4 years has taken their duration up past 7, so over a year long.
Still about 6.5 rounds.
And, you know, has gotten whipsawed for it. We found most high conviction core plus managers that we really like gain all their alpha in credit security selection and sector rotation, not duration bets. Like TCW is an anomaly when it comes to that.
Are you showing there on page 11?
Right.
That the average of these core plus managers, the duration still is around 6
Yeah, it's that gray area, so they're all hovering.
in that 6 area. And we're talking keeping it down around 2 or 3.
No.
No,
No, no, we're saying,
what we're discussing are alternative ways of lowering the duration.
By the way,
Because
that's on page 15. It's showing us
Right, these are the two
alternatives.
Right.
alternatives that we're going to.
one of the things is at one point, we were talking about being an executive session for this discussion, are we in it?
No, we're not in
We're not.
executive.
Not for this.
You don't want
I don't
to?
think so.
Okay.
So in page 2, in that case there, we're saying that this is, we're back to several months ago, looking at a path strategy of 1 to 3 years. And then almost like, having someone do that for us. And then that would then obviously bring down the duration quite a bit if we did that.
Yep.
And also the cost
Yeah.
structure goes down 15 basis points.
Exactly, and the credit risk will come down as well.
Yeah, because we don't wanna, we're not, when we say short duration, we still wanna be, like, not have a bet on duration versus the stated benchmark.
Yeah.
Otherwise, we're just taking
So
the same
put our
bet on the
duration-
opposite
put our
side.
Duration in line with the benchmark, basically.
Right.
That's what we're doing.
And essentially, the way I would look at mix B is yes, you'll shorten the duration of the overall fixed income structure. But you'll also have a more conservative liquidity sleeve if you need to raise capital.
We have the money in cash, or in this case here, it could be in these
But it
passive
does,
dollars.
in effect, it reduces risk.
Oh, yeah.
Yeah,
And you'll,
okay, all right.
So if you look at the mix A, mix B, looking at the entire fixed income portfolio, our duration on A would be somewhere in the 6-year range. And B
That'll be
would
on page 20 there.
Page 20.
Yeah, exactly. So these are some key portfolio characteristics. So the kind of second column after the yield is the effective duration. So for
Okay,
mix
there we go.
A, you know, you're right there around 6 years.
So the difference between mix A and mix B is about a year, pretty minimus,
But keep in
6
mind,
versus,
That's the size of the
That's-
bet that.
that's the size of the
5.1.
bet that TCW is making on the other side, so it is actually meaningful.
Mhm. Yeah, versus the 635, yeah. Okay,
Well, why not have a mix C where it would say 60-40 Prudential core and passive? I mean,
I think quite frankly, we don't think you need to be that conservative. You know, the pension plan still needs to take a certain level of risk. This is not necessarily the place where we're shooting for the stars, but we believe that core and core plus fixed income is a reasonable way to achieve that anchor to windward while also potentially eking out incremental gains. You know, if you think 20% in short duration, given the net outflows of the plan, could be reasonable to cover
1 year.
cover those in a very bad equity market. But having more than that is not something that we think is necessary. You know, you have the ability to increase your cash position if you want to take risk off the table. But we just don't think from a structure standpoint, it makes sense to do more than 20%.
Yeah, but
Yeah, and I-
we could have something seriously go wrong in the stock market. But we could also have something seriously go wrong in the bond market, which has been a poor performer for the last 5 years and a poor performer for the last 7 years. You look at the returns, so that all I'm saying is, I'm not trying to be, you could say I'm being more conservative, but if we can get 4%, that's better than these guys have done over 7 years.
Kevin, were you gonna add something?
Yeah, and yeah, I wouldn't dispute, right, at a point in time, you know, right now, those short-term yields are high as you know, monetary policy has gotten tighter. You know, but I think what we would emphasize is on page 25. You know, here we're looking at, you know, long-term 15-year period. You know, what do returns look like on the vertical axis versus standard deviation or the volatility of those returns on the horizontal axis. And so, you know, what we're seeing there is that, you know, we want to move up and to the left. And so that is kind of what is attractive to us about the core plus mix A there in blue. You know, still within bounds of your peer group, but in that direction of kind of up and to the left, you know, certainly better than the index there in black. And so, you know, the trade-off there is this mix B, the shorter duration approach in green. You know, it is going to be lower risk, right? We wouldn't dispute that. But it does come with that trade-off. We would expect a lower return to come out of that approach over a long-term time horizon, even though we don't necessarily know, you know, what is going to happen over, you know, say the next 3 to 5 years.
But one of the things is that the Fed's cut rates and the yield curve is just steepened, right? I mean, the 30-year traded at 5%, which it didn't trade at until the Fed's cut rates by over 100 basis points. So that's what the question I'm asking. Could there be could there be risk in the bond market? So that's, I'm saying I'm not, you could say I'm being conservative, but yeah. But the bond market, you know, if this bill passes, the deficit's gonna increase substantially. You know, it just seems to me that it's maybe prudent, because even if we bought short-term paper and Fed cut rates 50 basis points, you could be losing money on the bond side because of maturities. That's what's happened in the last 2 years.
I think that's why we always prefer to look longer time periods, just because it's too difficult to say what's gonna necessarily happen one way or the other, and we'd rather look at what historically has presented itself over time. So that's why I think Kevin is pointing to like the last 15 years. I mean, we could be in a regime shift, to your point, we absolutely could, and we could see another 5-year run like the last 5 year, or we couldn't, and I think we would rather remove ourselves from that debate and look at where we have the most statistical evidence, which is over the longer periods in time, and that's what this is telling us.
Well, you know, the bond was in a what, 40-year bull market.
Your
Right.
chart is on page 26, Frank.
I had that.
Yeah, and I think the only point I'd add there, right, is, you know, there are,
I mean, I don't know whether you know,
I,
we underweighted bonds, which was a smart play for years.
Kevin, did you have something you want?
oh, just, yeah, the only point I'd add there, right, is we have, you know, seen that play out elsewhere in the world, right? In the UK in particular, right? There was this moment where they had a prime minister briefly who wanted a similar approach to deficits. And so, you know, ultimately what happened was that there was kind of an upheaval in the bond market, a lot of volatility in markets. But it ended up being a fairly short-term kind of phenomenon, right? I mean, they've had negative repercussions because of that, but it's not necessarily the case that you know, bonds became a sort of a permanent terrible investment, you know, because of that. There were kind of consequences around that happening. So that's why we say that this is you know, an extremely difficult thing to call, to get, you know, the call on interest rates right. And yeah, we just don't have confidence that we can make a call about where interest rates are going to head over the next 3 to 5 years.
Which, by the way, is what TCW is essentially trying to do and getting wrong. And that's where we again, just would rather take that equation or take that piece out of the equation.
Well, I'm comfortable with mix A in the presentation. I mean, I think you're leaning more toward B or at least having the passive, get some chunk of it, right?
Yeah,
You'd be comfortable with mix A if we moved 10% away from the candidate manager into passives?
yeah, or even, you know, I just think that, well, the thing is that like the passive treasury, 1 to 3 years. I just don't want to be out of the yield curve. That's, you know,
Yep.
You know, I think that's.
so you would modify mix A to a 45, 45, 10.
Something like that?
That'd be fine. I got 45, something.
I'd be okay with that also.
And where the 45 one would be Prudential.
45 would be the
Passive
candidate core plus, and then the
10 would be the
10
treasury.
would be 1 to 3 year treasury.
Kevin, what are you hearing about? What's the sense of people that are closer to this than I am about credit risk in the next year or so on the corporate side?
There's a lot of disagreement out there, right? I mean, I think that there was some fear earlier this year in credit markets, right? As we didn't have, you know, any kind of certainty about the policy environment with regard to tariffs and what that would mean for growth. And so a lot of that fear has kind of subsided at this point. Not that there's, you know, certainty about tariffs, but you know, some of those worst case fears have kind of receded. And so, you know, that tends to be an environment where, you know, investment grade credit, you know, might perform all right, right? Because these are very high quality companies. And so they can weather, you know, things like recessions or difficult policy environments. Whereas, you know, perhaps the lower quality credit, whether that's high yield bonds or now this new market called private credit that's out there, you know, they, you know, perhaps would struggle more in these recessionary environments. So I think when you see, you know, some headlines more recently about, you know, fears in credit, I think that is more directed at the lower quality parts of the market rather than investment grade.
Well, what would be the blended average credit rating for most corporate core plus managers? You know, a weighted average credit rating for their portfolios.
Yeah, so we see a little bit of that on page 20. So these are your mixes relative to the peer group. So it's not exactly just the core plus, right? So mix A is 50 core plus, gets you to that AA minus. Yeah, so you're gonna see more like a single A if you were just looking at the core plus component.
Yeah, I think the one benefit here in terms of having that anchor with Prudential, they're a very conservative core fixed income manager. Not gonna take a ton of credit risk, really gonna try to incrementally
Is their average duration?
right on the aggregate in
That's
the 6 years. They're not gonna make duration bets. They're gonna try to incrementally outperform by a few basis points a quarter. And they've done a nice job in both the pension and the OPEB of doing exactly what they told the board they were gonna do.
And Jim, if we, you know, the other thing too is with the core plus manager, keep in mind that like, that's an active, right? So they're gonna react to what's happening in the broader environment and perhaps up the credit quality at any point in time if they feel it's in the best interest at the end of the day.
And the cost, the fee structure for Prudential is around 10 basis points.
I believe it's
It's a little,
12.
yeah, I think it's 12, TCW is 35-ish.
And the core years, in this case here, we're also saying that a future active core plus manager will also be in that 35 range,
Probably lower,
probably low, but in that, but not 10 or not 12,
not 10,
No,
25, 30.
25, 30.
Yeah, we've seen fee compression and core plus fixed income for sure. They've come down, but not to Prudential's level.
Are we working toward a consensus here?
Yeah, so what's the next step for you guys to present us with some core plus managers?
Yeah, if the board wants to move forward, we're certainly happy to give you our highest conviction core plus managers and present those to you in September.
So 45, 45, 10,
Well, we don't know yet.
We'll figure that out, but
Yeah, we'll figure that out.
okay?
You know, one of the things, Kevin mentioned about how the gilts, they had that big spike. Right? But they never came back. I mean, I have the chart up here now. In fact, they're making almost new highs. So what happened was they spiked. And they really, their higher yield is higher now, so therefore the bond value is lower now than at the peak of the spike. Right? That's,
That's right. Yeah. And we wouldn't, even,
Right, that's
even the
why-
spike in yields we've seen in the US, we're not making a call that those are going to need to come back down either. Right. So yeah, that would be, a big call from here to say that those should come back down. I mean, that arguably is kind of where TCW is positioned to benefit right now.
for the purposes of doing a search, because we usually attach it to a relative amount. Is it okay for us to work off of that 45%?
Yeah, I think that's-
you could give us information and we could decide afterwards.
Oh, no, I'm not holding you to that,
No.
but typically when we go back to them and we say, look, when we're running the search and we say to be at this amount approximately,
What
because
kind of
that's gonna
fee will
impact the
you show
fees. Right, vehicle options, things of that nature, so we have to at least have some sense of where we're working with.
Sounds right to me. You good with that?
We can give a range,
45%.
and we would also include OPEB in the search. That's,
Yeah.
makes sense for the board.
Okay. All right, good.
Great, we'll come back in September.
Kevin, this was very good
Yeah,
analysis.
there's some great stuff in here.
Thank you, Kevin.
I mean, I really like that one chart that showed how
For off the
far off the
reservation.
reservation. TCW was, I don't know if there's some way of. We talked about them making the duration bet and what they needed to do. I for one did not realize how far. I knew it was a year, but I didn't realize how much of a lone wolf they were.
Yeah.
Are we gonna vote to take money from them?
Don't have to. You can wait until you see the.
Yeah, but we
candidates.
love taking money out of bonds.
Sorry.
I mean, if their performance is bad, it's why,
They've done better this year.
Yeah, the duration thing is working in their favor now to a certain extent. We're just saying, take the duration bit off the table.
Yeah, we're not concerned to the point where we think you need to take action today. I think we do believe there are some very high conviction core plus managers in the universe that could do a great job and be duration neutral versus the benchmark.
Such that we don't have to discuss duration every month, right? Like, I mean, yeah, like, let's.
if we got rid of all our bonds, we wouldn't have to discuss it at all.
Yeah. Sorry, Frank.
Just a suggestion.
That one chart,
You have to go back to page.
yeah, that page 5.
Page 5.
We're gonna, I gotta have a poster that's gonna cover those
Those
over there and
times,
hanging from the wall.
yeah,
When you guys look at another manager, do you, what sort of guidance or feedback do you get in terms of their, how far they're willing to stray from the aggregate on their durations?
I mean, we can see essentially how they've implemented the portfolio in
Yeah.
terms of those duration numbers over time, and that's the proof is in the pudding in that regard.
Is that something that most of those managers would have a policy on, that no more than?
It's a
plus or-
philosophy more than a policy, I would say. I don't know if they're
Yeah.
beholden to like a strict range, but if they're telling you they're gonna do X and history has shown that they've done X, then
Okay.
yeah,
I think some have a stated policy, it might be more broad than they actually implement. So
Right.
They might say plus or minus a year, but if you look at the history of the fund, it's never strayed more than, a quarter of a year.
I think the difficulty is, if you you get some money in a 1 year and some money in a 30 year, and you go, oh, my average is 15, but it's really, you got a lot more exposure in 30.
Yeah, yeah.
But that's the thing that I'm concerned about.
Yeah, and in our full performance report, we do have duration distribution information for the total fixed income portfolio. 87% is shorter than 10 years of the portfolio, so most of the concentration is at 1 to 3 to 7 to 10. And
But 87%, 10 years or less, that could be 9 years. I mean, I'm just saying, right? So that's to say 10 years or less doesn't give you the average yield, the average maturity, right?
I'm sure we could break it down further if that's something you'd like to see.
Well, I think that's something I'd like to see.
Yeah. I think that-
Hmm.
Okay.
All right, anything else?
But yeah, we scheduled to have principal in.
well, I think the next topic is an executive session. to
Yeah,
discuss.
that's executive session.
Yeah.
Yeah.
All right.
All right,
Kevin, thank you.
Yeah, thank you very much,
Yeah.
Kevin. Excellent job.
Thank you.
Thanks, Kevin.
okay, executive session.
Okay.
Don, is there a motion to adjourn?
I would make that motion to adjourn.
Is there a second?
Mr. Baskin seconds.
All in favor?
Aye.
Thank you.
All right.
Thanks, everyone.
All right.
The meeting